Hello, everyone, and welcome to the MakerDAO Scientific Governance and Risk Meeting number 108, taking place on Thursday, September the 3rd at 1600 UTC. My name is Long for Wisdom. I'm the MakerDAO Governance Facilitator. I'm joined by a bunch of people, both within Maker and without. And yeah, we're going to have a governance and risk meeting. So I'll go over the agenda in a second. First thing to say, I guess, is if you feel like you have something to say, feel free to interrupt or talk over people. Someone will let you know if it becomes a problem. So please, we'd love to hear from you. Okay, so agenda-wise, we've got the usual domain updates. So we'll hear from each of the domain teams. We'll have a MIPS update as well from Charles. We're going to have a couple of presentations, one from Primosh, who's going to talk about setting the ETH-A risk premium. We're going to have Money Supply give a brief update on vault compensation in the wake of Black Thursday. And then we'll have our regular State of the Peg from Vishesh. Cool. All right, well, before we dive in, a quick request from Joe Q from Maker to remind people to run Auction Keepers, or if you have friends who might not be running Auction Keepers, to try and get them to run Auction Keepers. Auction Keepers are important, and as we scale DAI, it's important to try and scale the number of keepers as well. All right, so yeah, I think we'll start with the domain updates and then get on to governance at a glance. So smart contracts, do you guys want to give a update on what's going on?
Sure. We deployed PaxUSD and Tether to Kovan this morning, and right now working on the spell to deploy to the mainnet, which will go live tomorrow. Mostly this week and last week. With liquidations 1.2 behind us, been just continuing efforts on liquidations 2.0, have more concrete plans in coming weeks. The spell, which was created and drafted and scheduled yesterday to increase the ETH debt ceiling to 540 million, was executed about 7 hours ago this morning. So yeah, the ETH-A DC is now 540 million. Global debt ceiling is, I think, it's 708 million. And I think those are the highlights right now. If anyone has any from the SC domain team has anything to add, please do.
I think you hit the highlights.
Yeah, thank you, Will. Yeah, just to elaborate briefly on the executive yesterday, that was triggered by the risk domain team as a result of the high uptake on the ETH vault that was released recently. Cool. Let's see. Oracles, do you have anything to update us
on? Yeah, a couple things, right? So so last week we had fast tracked the Y-earn vote, and you know, because we were kind of concerned about the state of the peg, and kind of saw a lot of potential in the YETH vault type in helping us kind of bring the peg down. And so far from what we see, that does seem to be the case. It's actually quite astounding how quickly they've been able to stockpile ETH into that vault. So it looks like we'll be able to leverage a lot of growth out of that. So I think ultimately that was the right call. Looking forward, this Friday, Argent and MyCrypto have finished setting up their light feeds. So we'll be including their keys, which they've posted in the forum and signed a message with. We'll be adding their keys as light feeds for the oracles in the executive this coming Friday. And then TBTC is about to relaunch their new version, and so they had to deploy new contracts. So we basically need to do a polling vote to swap their Oracle whitelisting from the previous address they were using on the version 1 to the address of their new version 2 deployment. And that's it from my end.
Great, thank you, Nick. Cool. Risk. Let's see. It's pretty much here. Is Cyrus here? Do one of you want to go?
I can give the update. So we'll be releasing a comp valuation in a few days. We are also we had our independent risk grantee submit a Chainlink evaluation to us last week, and we're kind of going through that and reviewing the work and vetting it. That should also just get released maybe sometime later this week or early next week, probably, but in time for the governance cycle, I'm hoping. And then we also did an evaluation on the C tokens, which is going to be published soon. We're not recommending those. I mean, we're not submitting an application for collateral evaluation there. We'll leave that up to the community if there's interest, but we did an analysis for it. There's certainly interesting candidates, and a lot of the discussion can be, a lot of the analysis can be used for other similar assets, maybe stuff like YCRV or kind of whatever else comes down that path. So kind of excited to share that. And then what else? And then I think Loopring is going to get resubmitted as well, but that's pretty much going to be the same evaluation as last time. And then finally, unfortunately, don't think PAX-G is going to make it into this cycle. Just ran out of time. A lot of stuff going on in the ecosystem right now, and on top of the transition for risk. So we weren't able to get to that one for this cycle, but we'll for sure next month.
Awesome. Is that everything you had, Cyrus?
I think so, unless I'm forgetting something.
Cool.
Yeah, well, I mean, Primoz is going to give a presentation on the ETH-A risk premium, so that was something we spent a lot of time on as well. But yeah, I think I covered most of it.
Great, thanks. Cool, right. I'll do governance at a glance in just a second. Juan, did you want to talk about collateral calls briefly?
Sure, I'll give you a quick update. So my name is Juan, and with the help of Lea and Lucas from Centrifuge, we've been organizing these collateral calls where different projects present for 10 minutes, and then we have a discussion for 20 minutes, open to everyone, where you can ask questions and discuss the different collateral types. So far we had New Silver and Matthew Rabinovitz from 6S Capital, and then Shuttle One and Arcoin. And this coming Wednesday, so September the 9th at 5 p.m. UTC, we're going to have Rafael Kostman from Trust Tokens, who's going to discuss TUSD, TCAD, TAUD, and TGBP. And we'll also have 1inch that's going to be talking about Uniswap. So September the 9th at 5 p.m. UTC. I'm going to post the link to the agenda in the forum. And then 2 weeks later, we're going to have Stani from Aave discussing their token, and Tyler Winklevoss from Gemini discussing GUSD. Also, if you would like to discuss a project, I'm also going to post in the chat the forum so you can share your interest, and we can schedule the call for that.
Great.
That's it.
Yep, thanks very much, Juan. Looking forward to some of those. Cool. All right, I will run through governance at a glance quickly, and then we'll get to MIPS. Cool. So have been a couple of discussions recently. Most of them have been focused around MIPS, so I'll leave them for Charles. But there are a couple of things I wanted to highlight. So firstly, Primosh made a post titled "A Different Approach to Rate Setting," in which he describes. Actually, Primosh is here. Do you want to describe it briefly, Primosh?
Sure. Not really prepared, but
it's fine.
I was thinking of, I was thinking about you know, how we're rating rates currently. Maybe some things are not really in line. So I got this different proposal, which basically says that we're not really, you know, we're currently, when we're setting rates, we're basically a hostage of DIPEC, right? You know, if we raise rates, we might, you know, endanger the whole situation with the price. But if you're able to actually save that thing through, for instance, this is just one of the tools, lower liquidation ratio for USDC, then we can manage rates with more flexibility, in a sense that we rely more on, you know, setting rates properly so we compensate the risk, and on the other hand, also setting the rates properly so we position ourselves in the, you know, in the whole DeFi ecosystem. And I think that's particularly important now when we've seen that most of the DAI minting is done by farmers, and it is, you know, probable that raising rates wouldn't necessarily mean there's going to be a lot of unwinding and endangering the pack. So I'm not even sure if we need that tool to protect the pack. Obviously, I mean, probably we should be prepared for that, but perhaps it's just a different strategy of going forward, something we probably never discussed. It has a bit more business logic in it, and something we haven't really focused on. There are other things also, but perhaps we could have this discussion next time, so I don't take too much time.
Yep, great. That was perfect. Thank you, Primosh. Yeah, if that sounds interesting to any of you, in either positively or negatively, I suggest reading over the threads, kind of leaving comments with your thoughts. As kind of Primosh said, it represents I guess, a different direction in terms of rate setting. So it'd be good to get as much input as possible. Cool. The other main thing I wanted to mention, not really a discussion, but just that the source code pilot that hopefully most of you were aware existed has been extended for another 3 months. There's a link in Governance at a Glance to kind of see the details. But the plan currently is that after those 3 months elapse, we will put the proposal to governance that the protocol funds the source code rewards going forwards. So there'll be more coming out to do with that, you know, once we get to the end of those 3 months. But just as a heads up, and if anyone wants to read the plans, there's a link there. So in terms of signal requests, we've had quite a few this week from a couple of different people. So I think Sandpiper asked if we should increase the BAT-A debt ceiling, as it's currently at close to 100% utilization. So we had Aaron do a couple. So Aaron asked whether we should add a debt ceiling trigger for raising debt ceilings. So kind of asking if, you know, once we get to 90% utilization, we should automatically put a poll on chain rather than requiring like a signal request. And he then sort of had a kind of related signal asking whether we should limit vaults to a maximum percentage of the total DAI supply, just to kind of, which I think the intention is to kind of keep that previous proposal in line if things get a bit crazy. Then we had from Seb, we had a signal request asking whether we should use quantitative easing to fix the peg. Basically asking if we should set up a USDC vault with like 100% liquidation ratio, which was limited to use by the protocol for like a kind of forcibly arbing the DAI peg, or shorting the DAI peg, I guess. Let's see, then we had another couple of Aaron. So Aaron was asking if we should reduce the USDC-A collateralization ratio. I suspect this was probably prompted by Primosh's post that we mentioned earlier. And then, yeah, I think that's it. And then I guess, it's actually, yes, I should check the actual poll results. We had the poll for increasing the WBTC debt ceiling starting Monday and finishing just before this call. I suspect it has passed, but I'll double check. Yes, it's passed. So that will go into the executive on Friday as well. Right. Oh yeah, there was one last thing. So David Utero recently posted a help wanted post for a Reddit moderator for our MakerDAO. I think we have one candidate currently, but it would be good to get like sort of 2 or 3 mods on Reddit so we can keep things moving and keep things kind of nice looking. So if you're interested in that, please leave a message in that thread. All right, I think that covers what I wanted to talk about. So Charles, do you want to do the MIPS update?
Yes, sir. Can I get the sharing screen? Oh, perfect.
There you go.
Okay. Here we go. So this week's activity, as I mentioned last week, was a gap week between the August governance cycle and September's, and there were no polls or votes related to anything MIP this week, and September's governance cycle will officially begin on September 7th. And if time permits on this call, it would be great if we could have some of the authors that plan to formally submit their MIPS or sub-proposals for next month's governance cycle to just briefly talk about it or provide the links for their proposals for anyone to read who hasn't seen them yet. So next week is the beginning of September's governance cycle. It begins on the 7th specifically, and the formal submission period is from the 7th until end of day on the 9th. So this is the period when the authors of either MIPS or sub-proposals have the proposals in the request for comments phase and want to formally move it to the governance cycle by changing the status of their proposal in the forums. And then myself as the MIP editor will go and make the respective changes in the GitHub to make sure that it reflects those changes. On Thursday, Long for Wisdom will perform that submission review, making sure that all the proposals have met the criteria and requirements, and he will confirm which of the formally submitted proposals may be put forth in inclusion polls on the following Monday, September 14th. Collateral onboarding, we have PAX USD and USDT executive vote happening tomorrow. And in terms of the next month's planned collateral types, we have comp, link, and the LRC resubmission, as some of the domain teams mentioned earlier. And then we have the community greenlight polls will go live on September 21st in the 3rd week of this next governance cycle. And I also wanted to just share some collateral onboarding stats. Long for Wisdom, please correct me if some of these are incorrect, but I just wanted to show everyone how far we've come with collateral onboarding over the past couple months. So we've had 66 collateral applications been proposed so far. 26 collateral types have been greenlit by the community through polls. 11 were deferred and 9 are due for next month. And we've seen 11 public smart contract assessments published, 8 risk and 5 Oracle assessments. And in total, we've seen 6 collateral types that have been added through the MIPS process, with 2 in the pipeline to be potentially added by the executive vote tomorrow, and 3 scheduled for next month. I've added this new little bit just to reiterate some of the updates from before. I may take it out given that the domain teams have already covered it, but in terms of oracles, the executive vote to whitelist the Wire Finance ETH-USD Oracle had passed last Thursday. There will be an executive vote also in tomorrow's executive for adding Argent as the light feed, and the TBDC Oracle whitelisting poll will go out on Monday. And as for the Maker protocol, as Will mentioned earlier, the executive vote to activate liquidations 1.2 passed last Thursday. So we have a couple new proposals over this past week, which is exciting. In terms of the MIPS, we had MIP 21 get posted by Matt, and it is for real world assets, off-chain asset-backed lender. If he is on this call, he can speak about this at a later point in the call. And we had MIP 22 from Centrifuge talking about the direct liquidation module that they proposed. So these are both technical MIPS, and I'll put some links in the chat, or if someone else can now, please take a read at them. They are planned for, if they are formally submitted, would potentially be able to make it at the end of October cycle, but that is completely up to the authors, of course. And then the last one was the sub-proposal to pair with Matt's MIP 21, which is a declaration of intent for commercial points, basically talking about his plan on implementing the vision of real-world assets from the off-chain asset-backed lender perspective. I don't have a summary of this, so if he was on this call, he could give it, but I highly suggest to read these MIPS. They're very interesting and exciting. As usual, there are the typical candidates that are still in the RFC phase. I just wanted to provide an updates on when they're available to be formally submitted by the author. We had the MIP 20, the target price adjustment module, where the feedback period should be ending at the end of this governance cycle, making it eligible for inclusion in October. We have MIP 15 by Will, which can actually be submitted next week, and I believe he's going to do that. There's MIP 14, which was taken over by John Theithman. Forgive me if I mispronounce that. So we'll see hopefully some progress updates on the forums from him. And the MIP 17 weekly debt ceiling adjustment module is still a work in progress. If anyone else wants to get involved to push it forward, please message me. And then lastly, there's two declarations of intent, the diaflastinate module, which will be, I've heard from the author, at least Sam, that he'll be posting it for formal submission for September. And then the strategic reserves proposal, which RFC would end at the end of September, is making it eligible for October. Oops. Sorry about that. Lastly, there are a few new pre-MIP discussions. The vault liquidation mechanism for centrifuge trade finance assets, which was the precursor to the actual MIP 22 posted by Centrifuge. And another very exciting one, which is debt ceiling instant access module posted by Derek Flossman. Definitely suggest checking that out. It heavily relates to MIP 17's concept of having adjustments for the debt ceiling, but in a more automatic fashion and controlled by governance with less governance friction. And the active discussions that are still happening are, oh, it looks like I have a duplicate there, oops. The chief contract redesign, liquidations 2.0 system redesign, and adding a poll to prioritize collateral applications. So that was a lot for today, but I think I've covered everything. I will post my follow-up forum thread as usual, if anyone wants to see it as opposed to hear it. So thanks.
Great, thank you, Charles. I think if any of those mentioned MIP authors did want to discuss, or at least kind of give a very brief overview of their MIPs for the next 5 minutes, that would be fine. Does anybody want to volunteer? Or? Okay, seems like maybe not. We can always come back to that at the tail end of the call if we have time. All right. Okay, yeah, pretty much. Are you ready to talk about the ETH-A risk premium?
Yep.
Let me make you co-host. There you go.
Just a sec. Okay, hope you can see this. Okay, so today we are presenting much anticipated calculations on ETH-A risk premium. Spoiler alert, there's not going to be one pinpointed specific number from our side, but there's going to be a range provided. I'm going to explain later why we think this makes sense from our side. So how we approach the whole thing, we are using the model that we showcased earlier this year. This model is based on GBM, and it uses jump risks. It simulates 10,000s of paths, and we basically are interested in getting a distribution of losses from which we can then get a risk premium or so-called average loss. In this case, we actually outlined 3 scenarios, so upside case and downside case, and each of 3 scenarios actually uses different inputs, and these are called variable inputs, for calculating outputs. So the first input, which is, and these 3 inputs are probably the most important when it comes to such modeling. So the first input is auction slippage curve. This basically tells us when keepers come to auctions to bid. They normally bid below 100% simply because there are certain slippages used. I'm going to explain this a bit later into detail. The second one is collateralization ratio distribution, basically telling us what amount of debt lies below certain collateralization ratio, and finally jump risks. So jump risks are something that we apply on top of GBM model, basically modeling the crashes of Ether price. So something that, for instance, happened on Black Thursday. And here are the other fixed inputs. We keep this one fixed for Ether. And the most important one, of course, is volatility, the standard volatility. This is used from historical data. We're using liquidation ratio of 150 because ETH-A has this kind of liquidation ratio. Penalty is fixed. And then the one that's kind of important, it's kind of outdated, is the debt ceiling. Because I was making these calculations a few days ago. This was before White Vault. This was the old nominal number. So maybe the outputs might be a bit outdated, but in some sense, I think they aren't necessarily, and I'll try to explain that at the end why. So this is how we model the auction slippage curve. It uses its own model. I'm not going to go into too much details here because they require another call. But basically, we're using different inputs to, in this case, model auction slippage for an upside case. And the inputs are simply, for instance, collateral slippage means when keeper acquire Ether from the auction, they need to flip it on exchanges, and of course they won't be able to sell it at market price if you acquired a lot of ETH. The other one is keeper target profit. Again, something keepers just do, otherwise just doesn't make sense. There's DAI slippage as well, right? So keepers don't necessarily hold DAI, they might buy it, and if there's a shallow liquidity, it might cost lower bids from their side. Luckily, we have a lot of liquidity now in Curve, so this is not anymore so constraining. And then finally, there's keeper capital. We just used some numbers for upside base and downside case. And this one is kind of important as well, because if keepers wouldn't have enough capital, we would be basically hoping there is enough liquidity from outsiders that are able actually to bid on these auctions, which might be, infrastructure-wise not fit for everyone. And then there's bid discount. This is just one input. For instance, if keepers needs to mint DAI instead of buy it, he might bid lower on auctions because it just creates additional frictions from his side. So this is how the auction slippage looks like. This is for upside case. What it basically tells us is if we have $50 million of Ether sold in a day, you would have 20% slippage. This basically means that keepers would bid on average 80 cents on a dollar. And of course, it raises with higher nominal amounts of collateral sold, which is kind of logical. And then for the downside case, of course, the curve is a bit more steeper. There's a higher slippages applied, which means lower bids. In this case, for downside case, you would see 30% slippage, so 70 cents on a dollar bid. And for base case, we modeled about 24, but then it raises a bit more steeper than the upside case. So this is the auction slippage curve. this is one of the three inputs that I mentioned in the beginning, and this is varied for different scenarios. Then we're using jump risk, the second important input. Again, here I want to be clear that we did historical testing in sense that we use historical data, sorry. But the issue is, for instance, when we use only historical data, let's say earlier this year, you would see that Ether crashes at most 35%, but then Black Thursday happened, right? So here we then said, okay, let's do stress testing approach instead. Let's just, you know, put some numbers on different cases. And what this means actually is that we're basically calculating when we get the output, we basically know what we're hedged against, right? In this case, we modeled, so this one is the most important severity, the last one, which happens once per year, 40, 50, and 45, and then we have higher frequency for a bit lower severities. What's also important here is that these crashes are applied on top of the GBM, right? So we have regular volatility through time of Ether price, but then with a certain frequency, this high drop happens with a certain severity. And lastly, collateralization ratio distribution. This tells us when we have a price drop, what amount of debt is liquidated. And it all comes down to how well collateralized vaults are. And you can see the third column, current case distribution, is that you have 2/3 of debt collateralized by less than 300%, which actually means if you have 50% drop, you would see 2/3 of that liquidated, which is quite a lot. Now, why when we modeled it for 3 different cases, why did we lower this cumulative distribution of debt below certain level of collateralization? It's simply because I still believe that since you have all these automized tools and 1 hour time spent due to OSM, so automized tools, I meant the DeFi saver, and you know why ETH strategy is also actually automized in a way that it can unwind before you have a price drop. I believe that there will be some unwinding before we have price drop, but the question is how much, right? So the way we approach this is to say, you know, a downside case, you're going to see less unwinding, upside case, you're going to see a lot of unwinding, and the base case somewhere in the middle. But we did use some historical data on this. The issue is that this thing is strictly related to user behavior, right? And we know user behavior changes all the time, especially in DeFi. It's related, currently it's very much related to farms, and this can change a lot, right? So this is really a hard actually to assess these numbers, you know, probabilistically. Okay, so we used all those inputs and the fixed ones for downside case. I'm going to show you outputs for downside case. As I said, this case models for more severe price drops. It uses lower collateralization ratio, which means you get a lot of debt liquidated. And this is only one of thousands of simulations, so this is not an average, this is just one of them. So in this case, like I said, if you would have 50% drop like this one before, the blue line, you would get almost half of that liquidated, or basically this figure, 44% of the debt, which would mean you would have liquidations of 150 million. And then when you get this figure, what the simulation does, it uses this initial slippage curve for the downside case, and it applies a haircut, and whatever's below 100% collateralization is essentially maker's loss, right? And out of those 1,000 simulations, you get distribution of losses. This is how it looks like, and what we're interested is the average loss. In this case, that's 21%, 21.6%, or 73.4 million DAI loss on 340 million of DAI nominal debt that we set at the beginning. And the second variable is also kind of important. It's not related to risk premium, but it's something that we need to be aware of. It looks at the tail of losses. and basically says, okay, we still want to be protected against worst case losses, in a sense that we need to know Maker capital is able to dilute itself. So this downside case, what it basically tells us is if we believe in those set of inputs or assumptions that we use, we should realistically, charge vaults 20% risk premium, and we should always have 100 million DAI available in Maker capital. I'm going to explain it at the end what this all means. The upside case, this is the other extreme. You don't have so severe price drops. Price is more stable. The highest drop is 40%, which may still be a high one. As I said, historically, you didn't really see so high drops. So maybe the upside case is even too pessimistic. But then collateralization ratios are a bit higher, which means when you have a drop, you don't get a lot of that liquidated. In this case, you would get only 2 million liquidated debt. And again, if you apply the slippage curve, the one that's more optimistic, you would basically get positive outcomes, right? You wouldn't see any losses because there is penalty fee that is applied to it. So basically, the protocol is actually earning money and not incurring any losses. And what this means is that risk premium is it's actually a negative number, right? You shouldn't be charging anything to vaults because protocol is actually making money, and worst case losses are just zero. So Maker doesn't need to dilute itself in that sense. And then you have the base case. As I said, the inputs are somewhere in the middle. Collateralization ratios are, a bit more stable, a bit more, basically between downside and upside case. And the Ether drops as well. The highest drop is 45%. And you get, in this case, in this simulation, you get 70 million liquidated, which is about 20% of the whole exposure. And applying the slippage function, you get this kind of distribution of losses, and you get an average loss of 4.2%. So this means this would be the risk premium, and you would expect 14.2 million of losses per year, and your tail loss would be 23.5 million. Okay, so what does all this mean, right? Maybe somebody's disappointed because we came up with this, huge range from 0 to 20%. But what here I wanted to present, what are the differences between the inputs we're using for each output, because these are the three main inputs. You may see that there's not really a huge difference, or it may seem not to be, and the outputs are quite different, right? What we want to make sure here is that modeling these inputs is kind of subjective in some sense, even though we're using historical data and trying to really assess as much as possible what would be the outcome in all of the simulations. It's practically really hard to assess it because it all comes down. One of the major inputs is user behavior, right? And one good example, something I wanted to address in the beginning, is current ETH vault, where you would say, okay, but now we have a lot of debt at 200%. And if you would run the simulation to show you, there's going to be a lot of liquidations, just because we're modeling the thing that, not every user is awake and is prepared to unwind itself, right? But we know that that's not the case with Y-Vault. On some users, they are using these automized tools, and they can better protect themselves and also protect Maker. Which means that it really comes down to user behavior. And ideally, if you want to model this thing, you would need to assess every vault. It's basically how banks do it, right? They don't, they look at the loan portfolio and they have risk premiums or, some probabilistic losses on each vault. Here we're actually aggregating things because it's just simpler, but you can see it's not that simple, right? It's the whole methodology is anyway pretty complex. And what I want to make just a final point is that when governance decides, right, with what risk premium we should go or which one should apply, I think the best thing is to actually, look at the current environment and see what's happening with the liquidity, with debt exposure, and try to somehow, move from one side to another side and assess risk premium in this kind of way. And the other option is also to say, okay, governance wants to be protected against downside case, right? This is something they believe could realistically happen. We want to be protected against it. But then we need to know we need a 20% risk premium, right? And then we know if we set this up, the loan portfolio will just, there's going to be a lot of unwinding, people will leave, but then we're going to have lower numbers when we run the models again. And again, we're going to get to some balance, but we really need to be sure what we're doing with all this information. So that's pretty much from my side. Happy to answer any questions.
I had a question. So I'm seeing this worst jump once per year, like -40% to -50%. I'm wondering if that's like reasonable. I mean, the Black Thursday event, nothing had happened really like that before. So is it reasonable to think that will happen once per year, or should we be looking more at like once per 5-year, 10-year sort of event kind of thing? And how does that affect the numbers?
Yeah, that's a very good point. Actually, this is what I wanted to address. Basically, our main goal is here to show what's the mechanics and what are the cause and effects. But basically, yeah, this number is kind of important, right? If you just think about it, if you have 150% collateralization, and if you don't have more than 33% jump, and all auctions clear up with not really a huge slippage, then you would expect no losses, right? And this was what was happening most of the 2019, right? We had liquidations, they were quite severe, but the jumps were just around 30%, so we were always protected. But once you get to this 45, 50, it all becomes much different, right? Because you get to losses initially, right? From 150, you initially get below 100 collateralization level, and makers already incurring a loss, and then you put slippage on top of it, and it's quite different. And now to your point, what number should be applied? Like I said, like this is not something that you want to use historical data, especially in crypto. Obviously, I mean, ideally, you would want to crowdsource this information somehow, right? Maybe that's an way to go. I'm not really sure how to approach such things in the best way. Or like I said, you could say, you want to be hedged against this. You could say you want to be hedged against 35, but then when you have a year with more than 35% jump, you're not going to be compensating a loss through your risk premium, which is going to be, of course, lower.
Yeah, thank you very much. That was, I think, very informative. Does anybody have any other questions they want to ask now? Or yeah.
I have one that is related. Would it be, sorry, would it make sense to kind of turn the logic upside down and see these probabilities as targets, as to say that the policy is that we are protected against a drop of this size every year or every 2 years, right? I think that's kind of turning the logic upside down, but it may actually make more sense if it's anyone's guess what the real numbers are.
Yeah, this is what perhaps I wasn't clear. This is this approach when you basically, like you said, you want to be hedged against a certain scenario, right? You set it in advance, and then you see what's the risk premium, and then you pursue that risk premium because you want to be hedged against that. Was this what you were thinking? Because this was one of the approaches I had in mind. I perhaps just wasn't clear.
Yeah, I think we're probably saying the same thing. Okay, yeah, thank you for clarification.
I have a slightly related question, actually. What are the next steps for setting the ETH-A risk premium? Should we like poll on what people want to set this to?
Not really sure. Is this a question for me, or Long, do you want to answer that?
Whoever.
So if you ask me personally, definitely we need to update them, because here's the reason why I also made the last post, right? So how it's going now, that when we want to change a rate for a particular asset, we either increase the base, we either change the base rate, or we set the risk premiums, right? What I think is not proper is to, to basically set a risk premium higher just because, we think we can also charge more in some sense, right? Because we might get to occasion where we're going to charge more, but the risk is not, the risk is just not proportional to that necessarily. So I think risk premiums is totally different topic to stability fees. Maybe that's something for, for future debates about, what I was proposing there. But definitely we need to refresh all the risk premiums that should come specifically from risk side, right? Not from the side where, we increased risk premium just because we wanted to reach higher stability fee. We were kind of intuitively saying, okay, the risk increased, let's increase the risk premium because we want to have higher rates. But what I was referring in this post is, if you're increasing the rates, important part is we should just know what the real risk premium is, and then we compare it with it, right? And then if we see a deficit or surplus, we should have a better guidance of what we're doing in terms of risk.
Yeah, completely agree with that. The risk premium should be exactly set by the risk team only, and not just, community popularity votes, in my opinion.
Yeah.
Cool. All right. Thank you, Sam and Pramesh. Yeah, I think from kind of my perspective in terms of setting the ETH-A stability fee, or risk premium, I guess nominally. Yeah, I think maybe we would want to sort of look at Pramesh's model and potentially poll on inputs. Could be a method of doing it, right? Kind of figure out what, like Pramesh was kind of saying, like crowdsourcing, like what's kind of things we expect to happen, or like what sort of levels people are expecting from the market. I'm not sure how scientific that would be, but that would be one way of going.
Good. Thank you.
Sorry, did you want to say something, Andrew? No, you're good.
Oh, no, sorry.
Cool, that's fine. Yeah, so that would be one method. The other method is just to, I guess, do what we've been doing so far, right, and just poll directly on the value, like we've been doing for the other assets so far. Cool. Oh, go ahead, Yoel.
Yeah, I've got a comment to that. I think as Primoz was mentioning during the call, and I think it's important. It's important to always have the community to to open to discuss potentially some of the models, and and validate and have some scrutiny. I think that's a healthy thing that actually helps the risk teams to also think about maybe things that we're not considering during the model, as every model is as good as its assumptions, right? So it's totally valid discussion, I think, to have there. But I think, as Primoz was saying, is important as well that there is the data, in particular when the data is actually available with some historical breadth, like ETH, for example, it's taken into account when actually doing those inputs. And although we may not have like ETH crashes happening at 50% level every time, this market is highly volatile, right? It's still we're not talking about shares or even like housing. So it's important to take into consideration some of those aspects, because we cannot control so much actually the main driver of some of those jump risks, which is user behavior. So I think the approach there from Primož is important to always look at like historical data, the historical distributions, and then use some of that to take into account into the model, because this model here is not a model like a predictive model. In a sense, it's more like a stress testing, and the stress testing are based on scenarios. It's always based on what is some of the worst things that actually can happen, so that actually you have buffers to prepare for that. And therefore, with that in mind, then you can have, after the scenarios are covered, you can have a discussion about, okay, what is, once we have those scenarios in place, to say like, what is the likelihood of such a scenario being this bad in, in the next, 12 months or so. And then once you have plotted that and you have put your risk premiums in place, you can go and, as we're having a discussion with Primož, you can go and go back to the data and monitor on a forward-looking view whether those scenarios that are put together will maybe too risk adverse, and therefore you can, again, looking at the data, the actuals versus the forecasted, and actually try to potentially recalibrate some of those risks that that you thought were maybe higher than you expected or lower than you expected, in which case you actually have to look back at the data and potentially increasing them if they were lower than you expected. So I think it's kind of, it can be relatively dynamic, but I think it's important to base at the data and to look at some of the worst points of it and try to have a buffer for it, rather than after the fact, diluting MKR or doing things on a reactive basis rather than a proactive basis. I think at the end of the day is kind of like the approach.
Great. Yeah, thank you for that, Will. I think that makes a lot of sense. All right, so I think if there aren't any immediate people wanting to jump in, I think we'll move on for now. Manos, are you here?
Yep, here.
Cool.
Yeah, no presentation for everyone, just like a super short update on vault compensation. So I just posted in the vault compensation plan V2 thread. You can read the like short little post at the end. But essentially, we're planning on the next poll going live on this coming Monday, September 7th, and running for 2 weeks until September the 21st. And then there's some kind of more clear details of how the compensation calculations work that I put in that final post. I feel like I didn't do a great job of explaining it in my initial post. So for anyone who has any like not totally clear on how the compensation works, feel free to reach out to me on chat, but also look at that post. One important update is that I had made just like an oversight when listing the initial MKR amounts that would be like the maximum required for each compensation percentage. I had been mistakenly multiplying the compensation, like the collateral deficit percent, by the debt tab rather than the value of the collateral at the time of liquidation. So the post explains kind of more of what I was talking about, but all of the numbers for MKR, because of that oversight, basically they just need to be multiplied by the 150% liquidation ratio. So everything is going to be 1.5 times larger. But all of the numbers should now be 100% correct for the maximum amount that'll be required. So hopefully that'll give everyone a clear idea of what they're voting for as they consider these upcoming decisions. One other note is if the poll doesn't
get at least 50% support for one of the compensation options, or if it resolves as opposing the current compensation plan but supporting vault compensation in principle. The working group, myself and everyone else involved, have kind of determined that that would be a signal that we need a change of leadership. So we would, of course, be available to anyone else who wanted to take the lead on the process. But yeah, if the vote results either inconclusively or to opposing the current compensation plan, I guess we just kind of consider that as a vote of no confidence. So we would be, letting someone else from the community take the lead at that point. That's the, all the updates I had, but if anyone has any questions about that, feel free to hop in.
All right, I'm not hearing anyone jump in. So yeah, thank you for that update, Mane. As Mane kind of said, there's kind of a post in the forum. The poll will or should go live on Monday. So yeah, I would again encourage everyone to just vote, or at least I'd encourage larger holders to vote, even considering the high gas prices. It'd be good to be able to sort of move this forward or resolve it in some way. All right, we're on the hour, but I think Vishesh, do you want to do a sort of quick state of the peg updates?
Sure.
Let me just give you permissions. There you go.
Okay. All right, so a pretty eventful week. Total DAI supply is up to 520 million. 430 or so of that is from ETH. About 5 million from BAT, 6.2 from USDC, 78 from WBTC, and about 5 from USDC, or 5,000 from USDCB. So just to touch on, there's been a pretty crazy amount of DAI ETH trading volume in the last few days. So what we saw basically was ETH price had come up a little and come back down a bit, but DAI price basically was holding steady around $1, $2, and then had come down quite a bit to like $1.04 basically in the last couple of days. There's a lot of volatility with that number though, so keep that in mind. There were individual trades still occurring at like $1.03 and individual trades that occurred below the peg. So, a fair amount of slippage given that there was just a tremendous amount of volume that's been pushing through. And so we saw a lot of those trades happening on Uniswap, which explains a lot of the slippage. If you can see here, basically just the graph of that volume and where that volume is occurring in terms of price. And so at least for DAI ETH, just 230 million DAI traded for ETH in the last 7 days, which is pretty extraordinarily high for a 7-day average, and just a huge chunk of that on Uniswap. In terms of some of the other pairs, so DAI USDC pair, what we've basically seen is this kind of echoes that same price movement where, in just the last few days that has come down a bit closer to the peg. DAI USD is also a very volatile pair, but still showing kind of that same trend. Decent chunk of that happening on Coinbase. Some of those Kraken trades seeing a fair amount of slippage. DAI USDT, again, similar story. And a decent chunk of this happening on Curve. And the DAI USDC, a decent chunk of that as well was Curve. So if we look at the underlying DAI supply and what's happening there, So BAT basically, you know, we touched on this prior, but that utilization has come up right up around the 5 million mark for BAT. Well, I'll come back to ETH in a sec. For WBTC, it's been holding steady over the last few days around that 80 million mark. And then for USDC-A, that still has been seeing a lower utilization around first 11 million and then fell to about 7 and then about 6. ETH-A, however, so I'm going to zoom in here. Basically, what we saw was in the last week, you know, it was holding steady, growing a bit, and then just in the last 2 days, with a lot of the Wiren vault activity, this supply has just exploded again from about 350 million to 420 million. So just in terms of the big picture, you know, obviously the DAI ETH supply has been growing and growing, and each time there's a new sort of yield farming outlet that is discovered or grows, we see this curve kind of accelerate. It's important to note and keep everything in perspective that during this time frame where there were fewer of these opportunities cropping up, we saw, you know, somewhat of a flattening of that curve. But, you know, again, we're sort of back into that kind of growth phase of the DAI ETH supply. So we'll have to watch sort of how much this can continue to grow. And I'll touch on that in a second. But just to circle back, Compound had been one of the primary sources of the excess supply of DAI and where it's sitting. There's about 160 million in the DSR and a similar amount sitting in excess supply in Compound. This prior had been a higher value, so we're seeing some shifting of where capital is deployed. We see, you know, basically 100 million in Curve, and, you know, effectively 92 million of that is from Wiren, 70 being from YETH, and then the YETH vault, and then about 22 from direct deposits. So, and that's, you know, that's something to touch on as well, because basically what had happened this morning with when that number hit around 70 million, deposits were paused. So it'll be interesting to watch what happens with the multi-sig here in terms of this cap and how that influences the amount of mintings. Because if that cap gets moved again, it's very likely that the demand is for more than 70 million, and so the supply minted from that source would reasonably be expected to grow as well if that cap were moved. So that's a parameter to watch in terms of the amount of DAI that is minted and by extension makes it onto the market, or the amount of liquidity that exists out there. So this is that vault for the YETH deposits. You can see there's the 70 million in there. That's sitting at about a 200%, a little higher than 200% collateralization ratio right now. A lot of this is set programmatically. So again, this is some of what Primož mentioned in terms of how this is managed in terms of risk will be interesting to watch, because that is a lower, that's on the lower end of collateralization, but at the same time, it's theoretically managed more automatically than most vaults are. So again, weighing the type, the nature of that risk will be something that is interesting to discuss. But just be aware that right now, a tremendous chunk of the DAI supply is 250% collateralized or lower, which presents a fair amount of risk as well. So quite simply, a 15% drop in the ETH price at this point in time would result in 25 million DAI being liquidated. And if the ETH price were to drop to 303, you would see a total of 130 million DAI being liquidated, which is, I believe, an amount that is at this point in time capable of bullying the liquidity that exists for DAI. And so, though the price has come down a bit, we do need to be aware of what sort of risks are stacking up in terms of potential liquidation events. Because right now, with the tremendous amount that's being minted and locked in these vaults, the potential for a single wall mass liquidation event is probably one of the more prominent risks to consider. And then just to touch on, there's an additional almost 20 million or so DAI in balancer pools. Just in terms of where that supply is going, we just see a huge percentage of it being locked up in these farming opportunities right now. Okay, I will stop there, and I'm happy to double click on anything people have specific questions on.
Cyrus, one thing I wanted to ask you about is with transaction fees going higher, is there some concern about risk clumping in some of these? I guess the smaller things we're not too worried about, 10 million and under, like WBTC in particular, as an example.
I'm guessing that was directed to me. So I'll just go ahead and answer. So in terms of the other collateral type vaults, I mean, these collateral types are in large part clumped into large single user vaults. So a decent percentage of the supply of each of these collateral types is like that. So we see 38 million of the WBTC vaults is in a single user vault. And then we got 21 million, 12 million, et cetera. So basically, there is a large grouping, or there is a fair amount of clustering in the distribution of debt in vaults. I'm not sure if that was specifically your question. I didn't understand what you wanted to know about the transaction fees, but yeah, there's definitely a component of the risk to be aware of that you have right now, the way things are working, a few large users or a few single contract vaults, etc., where a very large chunk of the supply is clustered into, say, 5 to 10 positions. There are quite a few vaults within each collateral type, but in terms of percentage of debt, it is pretty heavily clustered, yes. Higher transaction fees. Okay, well, yeah, so I mean, I feel like I did answer the question in the sense that there is risk clumping. Now, whether that's due to high transaction fees or not, I mean, there are transaction costs 100%, but also just the nature of the way capital is deployed. What I think is going on more is you see a few trading groups, you see a few smart contract projects where you have automated yield farming, etc. You see a few of these opportunities where there's large amounts of capital that just by the nature of their size dwarf what individual users tend to do. And so it's not quite the same as saying like traditional industry definition of like industrial usage, but like to some extent you are seeing like more firms and projects and companies using these kinds of vaults. And so it is a bit more of an industrial than a commercial usage of these products. And I think that's what causes the clustering of capital, and by extension, the clustering of the risk. I don't think it's specifically due to high transaction fees, but that definitely contributes. Okay, I don't see any other questions, so I will give control back to you, LFW.
Yep, fine. Cool. So we're about 1:15. We can maybe go like another 5 minutes if people have questions about anything that's come up so far. Please speak out. Okay. Oh, sorry. Yeah. Did you have something?
Yeah, it's not related to the meeting, but MakerMan just make a post in the forum for a long-term vision of MakerDAO. I did something similar 10 days ago, so I just wanted to tell everyone that you can post there. I think it would be very interesting.
Great. Yeah, I did also see you just posted that. And yeah, you're right. It would be nice to see what people think on that front. Cool. Okay, I think we'll end things there then. It doesn't seem like anyone has any pressing questions. So thank you everyone for coming. And yeah, I will see most of you again next week, I expect. Thank you.